Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
And good evening, everyone. Welcome to MacroEdge Radio. This is John Galt speaking. Tonight, return guest for episode 78, Ross Hendricks has been kind enough to join us again because let's face it, folks, markets have been somewhere between crazy, insane, and manipulated. I like to think all of the above. What we're going to try to do tonight is dissect the macro impacts of what we witnessed since the war began. Everything is happening in commodities, but more importantly, what is going on with these markets, because people who are actively engaged in this are witnessing things that we haven't seen since 1987, shall I say 2000, and even 2007. Ross, welcome back to MacroEdge Radio.
Hey, John. Thanks. It's great to be here.
So let's get your first impressions on everything we've seen this summer as the volume dies and everybody leaves town for the last couple of weeks in preparation for the Jackson Hole Grand Celebration.
Yeah, well, I think you summed it up. It feels like it has been a quiet few weeks, but at the same time, I think your description of somewhere between insane and crazy is pretty spot on for this market. Even though we haven't seen a ton of volatility lately, there's a lot of craziness happening out there.
What do you make of this play? Now, I was expecting a rally with earnings season, and that's nothing unusual. Everyone who's been paying attention to markets for more than 5 minutes knows that. But what do you make of the evolution of the cheerleader rah-rah section saying that every good earnings report is a sign that the economic boom is still intact and moving forward? But the bad reports, the bad data coming out of some of these companies is just brushed under the rug and once again ignored, especially details in some of the winners' reports that are being overlooked deliberately, obviously, to promote their equities.
Yeah, I think that's the challenge. Is it's kind of a tale of two coin. I think you've got two different sides of the coin of what's really becoming a financial bubble. And the thing about a financial bubble, especially one that's really a CapEx bubble, which is what we've got now, and I think the closest analog was the dot-com sort of build out in the late 1990s. The earnings are impressive if you look at sort of the hyperscalers and the entire value chain that flows from this data center build out, all the way from the turbines that Caterpillar is supplying to the memory chips, the different utility providers. There's a whole value chain that's riding along this CapEx boom. And yeah, for the moment, there's a lot of great earnings reports coming out. But then if you look at sort of the flip side of that, is like, okay, well, what is the end source? Like, where is all the money that's coming from that's going into this huge data center build out and all of the associated supply chains that feed into it? And the answer is we now know, based on some reporting from Ed Zitron, who's done a really good job kind of digging into this space, is that at the end of this big CapEx boom, you have 70% of all of the money that's flowing into the hyperscalers that's driving these massive cloud computing revenue beats, which is really the majority of the earnings growth at the data center level. And of course, that filters all the way down to the chips and everything else. But the majority of the money is coming from the two biggest money-losing startups that the world has ever seen, which is OpenAI and Anthropic. So, it's very tempting to just look at what's the end results of all this. Okay, great. There's a lot of money that's being flown into the hyperscalers, cloud computing segments, and there's a lot of money that's being pushed into chips, energy, utilities, memory, everything. But you have to ask yourself, how sustainable is this when the end consumers that are spending all this money are burning tens of billions of dollars every year, and there's absolutely no I think, indication whatsoever that these companies are ever going to become profitable. And I think that's the biggest. And you saw the same thing in the telecom build out, where you had the telecom, everyone that was laying down the fiber is essentially the GPU buyers of today. And you look at all that end demand, a lot of it came from this whole rich startup ecosystem of companies that were feeding into this .com boom. And ultimately, there was there was a lot of earnings growth. People say that it's different now versus the .com boom because it was profitless IPOs. But if you look at the majority of the gains that, drove the market cap, it was the Ciscos, the Lucents, the Nortels. These were highly profitable companies, and they were growing like weeds every quarter, more and more revenue, more and more earnings. Until one day, that whole startup ecosystem fell apart, and a bunch of companies that were involved in laying down the fiber and supporting the growth of things like network switching equipment and all the components that went into the internet build out, when those startups started going bust and the IPO window closed up and you could no longer, the venture capitalists would no longer fund them because they couldn't cash out in the IPO market, that whole thing reversed on a dime, and you had a 40% drop in S&P earnings over the course of 2 years. And so the question always becomes, sure, we're seeing great earnings today, but is it sustainable? And if it's not sustainable, then it's really only a question of when does this whole thing unravel? And I think people should not get too comfortable with the earnings estimates that you're seeing and this trajectory that we're on, because there's a lot of reasons to believe that we're kind of getting towards the very late innings of what's going to keep this circular motion of money losing companies pouring into the rest of the economy. I think we're going to start to see that that's going to come unraveled probably sometime in the next 6 to 12 months is my bet.
Well, that brings us to earnings. Before we get into the hyperscalers and the chip and the circus known as AI, because there's a lot to discuss there. Because it does parallel the Lucents, the Alcatels, all the great companies that we never see anymore. And for some reason, even Nokia rallied in the last couple of weeks. God knows why. Maybe they're bringing back a version of the BlackBerry in Swedish. I don't have a clue. But the thing I'm looking at is there's something that people are missing in the earnings reports that, those of us who are considered geeks or people who actually follow this, some of the companies are reporting a certainly greater than normal surge in revenues at the behest of tariff tax refunds, and just calling it revenue, not isolating it unless you really dig down into the minute portions of the report. And that should be disturbing, because if you take those revenues out, it looks like the second and third quarters are going to be somewhat flat once you minus those numbers out for quite a few companies, especially those on the retail side, companies like Apple, et cetera.
Yeah, that was another big kind of boondoggle where, it's funny, the analysts looked past the tariff as a one-time hit and we're like, all right, no big deal. We'll just cross that out and, we'll look forward to next year. And then all of a sudden, when it gets factored into the earnings beat, everyone cheers it and doesn't mention, oh, it's just a one-time clawback of what we already gave up in the prior period. And so, yeah, it's more of the same. I think you put it well. It's like we're in a sort of manic market environment where all the bad news is just shrugged off. No one cares. And any reason to get excited, even if it's a one-time tariff refund, that's enough to get people to get all bullish again because, hey, the earnings are beating estimates.
And that's the thing that's frustrating about this, because a lot of us are realists and we try to look at it, project forward, and we're being told that because of this revenue boost and the quote unquote soon to come that have never come lower rates because of war, the outlook for the economic growth of this country is fantastic. But once you take the AI circus out of the equation and you start looking at the headlines, like the jobless boom headline from the Wall Street Journal this afternoon, you begin to realize things aren't as rosy as they want to be projected. And granted, I have the Perma Bears label, and I'm looking to take over David Rosenberg's mantle on this since he went full bull. The truth is, there's a lot underneath the surface that people just refuse to recognize, thinking that this economy is not perpetuated on fraud like the circular financing we've witnessed with the chip industry.
Yeah, and it's funny. The economy itself is becoming very circular because I'm with you. I think if it's and this gets back to everyone's talked about this, the whole K-shaped economy. If you strip out the top 10% of which are the majority asset owners in this country, and you just look at the average everyday person going to work and living on their paycheck, that person, that bottom 90% is really struggling, and you can see it just anywhere you look, whether it's the delinquencies in auto loans, credit cards, student loans. Those are all up to or near previous crisis highs, because those are the bottom end consumers that are all reliant on debt to kind of fund their lifestyles, because their wages aren't keeping pace with inflation. And another crazy statistic I read recently was that 25% of buy now, pay later loans are going just to buy groceries, which is, I mean, that's an insane state of affairs in a country where you're having to use credit to buy groceries. I mean, that's the ultimate, and you've got no other option. The Federal Reserve actually released a study, and it was like, a major reason people are citing for using these buy now, pay later loans is they literally have no other option to make ends meet. And so you're seeing all this everywhere you look, signs of stress, and you see it in the earnings reports of certain retailers, whether it's, you can look at the dollar stores, although they've had a little bit of a comeback recently. But the bottom 90% is getting crushed, and they're being increasingly offset by this huge spending boom by the top 10%. But if you look at the top 10, it's not like there's some huge productivity gain or wage gains. It's all the wealth effect. We've had this stratospheric, asset price bull market, and everyone's getting rich if you own assets, and that's a huge tailwind to consumption for the top 10%, which is now over half of the total consumption in the economy. The part that's scary is if you look at a chart of the percentage of household net worth that's just tied up in the stock market. We are now at the highest levels in history, and we're well above the prior peaks that you saw. Like this same kind of dynamic was kind of going on to a much smaller degree in the dot-com bubble, where a big part of the consumption, like there wasn't a big jobs productivity boom, but a lot of the consumption growth during that period was just people spending their perceived wealth in the stock market. And then we all know what happened. That's a very reflexive thing. When stocks go up, it's great. You can spend more money because you feel wealthier. The economy, limps along with this extra boost of consumption. But as soon as the stock market goes down, it could go down for any reason. Then you take away the real power of the spending in this economy. And that's how you can get a self-reinforcing recession, where lower stock prices lead to lower consumption, leads to slower business activity, layoffs, and then you get this hit to, income drops, and that's further weakness in stock prices. And that's how you get a situation like in the dot-com bust, where it was, you lost 80% in the NASDAQ because there was just so much wealth tied up in that bubble, and it was brutal. I mean, as much as euphoric as it was on the way up, it was it's the opposite side of that mountain. Was just a brutal, crushing 2-year bear market. And I don't think enough people appreciate how reflexive this economy can be, where you don't need to wait for some major tail risk to come out, like during the financial crisis where the banking sector melts down or anything like that. You could have something as simple as stock prices just stop going up all of a sudden. And that leads to that downward self-reinforcing spiral, because so much of this country's consumption is just tied to the wealth effect at this point.
Which is why I think we're seeing a revision in the calculation of PCE, which is going into effect this month in the reading, where financial advisors, because of the dollar volume of the equity bond / financial market trading is so high, they're reducing the weighting in the calculation of the PCE, which will bring inflation down 0.1%. But the reality is they don't want to count the inflated stock prices as part of the greater inflation. But when you see what MacroEdge and Don Johnson posted this week, highest all-time total ever, even inflation adjusted, for margin debt. And that's a
Right.
terrifying thought, that we're loading poker chips out to every Tom, Dick, and Harry who can get a Robinhood app on their phone and a credit card to buy 100 shares of some BS coin or some cyber bank located in Panama or God knows where, and saying, yeah, this is an efficient way to run an economy.
Yeah, I mean, we just saw what that looks like in Korea when that big margin bubble unwinds, and I think it's, yeah, I mean, there's it's just, we've just created this massive tinder pile, and at some point, who knows when, there's going to be a spark, and having that much leverage in the system is just, we're setting ourselves up for an epic debacle. I think it should be clear to anybody who looks, and that's the scary. It's just a line chart that goes up and to the right, like exceeding all prior peaks. It's pretty scary.
Well, let's go back to to one of the sources, which is the equivalent of the .com. I've been around for quite a few of the booms and busts. I was around for the personal computer surge of the 80s, the .com boom of the 90s, the real estate boom of the noughts. And when you see it, the cycles play out, and you see what's happening now. The skepticism about AI is not unfounded, but it seems that we're at the peak of the rush to get every IPO out that we can so that the founders can profit. And with all of the machinations going on with Anthropic and OpenAI recently, it does appear that that's going to be the marker or the top for this cycle. What's your take on this?
Yeah, I think you're 100% right. I mean, that is the classic sort of, if you're looking for a catalyst, and I think it was Paul Tudor Jones who recently talked about this, and also Jim Chanos, who are both some of the top market veterans everyone should listen to when they speak, and they both kind of echoed that same sentiment, is that when you see this flood of issuance, that's almost always a hallmark of the top, because you just at some point overwhelm the buying pressure in the market. And I think it's going to be particularly a powerful catalyst this time around, because again, the major source of, if you think about what the venture capital game is, which these companies are privately held, and it was the same story in the .coms, where you have venture capitalists that don't necessarily care at all about any kind of trying to, they're not in the game, they're not playing the Buffett game, where it's like, I'm going to look at the forecasted future cash flows of the business, and if I invest $1 today, I might get back $2 or $3 in the next 10 years, and I can discount that. Maybe it's a 15% cash on cash return. That's my investment thesis. That's the standard value investing playbook. But when you're in the venture capital world, and especially when you're in a full-fledged mania, and you realize that there's a wide open public market for anything related to, whether it was .coms in the 90s or AI today, you don't have to care anything at all about the fundamentals. All you have to care about is you're funding the business at a valuation of X, and eventually it's going to go public at 2, 3, 4, or 5X. But at some point, the market, when you start trading publicly, the market is relatively efficient. And I think what we're going to see, and you saw this in the late stages of the .coms, and you just had a flood of some of the worst trash that started to go public in '99. And these IPOs started, in the very early phase of the boom. There was so much excitement, so much pent up buying demand that, it started with Netscape in '95 and went on for 3 or 4 years. But eventually, you run out of the good companies to go public, and you start bringing the trash out. And when you start getting IPOs that go bust very quickly, they call it the busted IPO, where it goes public at 100, maybe it has a 1 or 2 day pop, and all of a sudden it's down 20 or 30%. That starts to really kill the overall market mood when you have people that are all of a sudden on margin sitting on big losses. And we saw that with SpaceX already. I think that was kind of the starting gun that's kind of telling you that we might be reaching the limits of unprofitable IPOs. And so the big concern I think investors should be wary of is that you have OpenAI and Anthropic, and it's, yes, they have great revenue growth, but the unit economics of these businesses, I think, when we get to look under the hood and see the actual financials, I think it's going to shock people how much money these companies lose. And when they do go public, if those IPOs have a hard time out of the gate and start getting crushed because nobody wants to pay a $2 trillion valuation for a company that's burning through tens of billions of dollars every year, that I think could put the pin in the bubble, because ultimately, we go back to our starting conversation, the source of all this capital that's flowing into the data center build out, that's juicing the earnings of the hyperscalers and everyone in the value chain. It's basically a big subsidy from venture capitalists. They give the money to OpenAI, they burn it, they spend it throughout the ecosystem. There's great earnings for all their suppliers, but they're burning all this capital. And that game goes on as long as they have access to that external capital. But once you go public and you're under the harsh scrutiny of quarterly reporting, and if all of a sudden demand for your stock goes down because you're off 30 or 40 points from the IPO price, it becomes much harder to raise that capital. And that's, I think, what could cause this whole thing to grind to a halt. So I think that's what I meant when I said we have got 6 to 12 months, because I think over the next 6 to 12 months is when you're going to get the Anthropic IPOs. They look like they're slated for the fall. And then OpenAI looks like it's slated to come right after that, maybe later this year or early 2027. And if those IPOs have a trouble and they do a repeat of what we just saw with SpaceX, I think that could be the pin that finally causes this thing to unwind.
I honestly, I take a little bit of a contrary position, not because I disagree with your theory on that, but I think that Anthropic is under the gun to issue that IPO before the end of this month. If they're going to take advantage of the market peak, I honestly believe they have to ride the coattails of NVIDIA into the end of this month, and before Kevin Warsh comes out and makes an utterly, probably bearish, devastating 2-minute Powell-like speech about we've got to defeat inflation no matter the data, and shocks the world, which leaves OpenAI, which is in total disarray with everyone quitting now. You were talking about that earlier. I saw that. I was like, yeah, that's not a good sign.
Right.
I really believe that they're in a pinch to get this issued before any type of major market correction occurs, because the war has thrown the uncertainty principles front and forward into the calculations, but nobody even wants to talk about the consequences, which are about to hit our shores.
Yeah, no, I think you're right. I think Anthropic is for sure racing. They're trying to get this thing out the door as soon as they can, just to capitalize on this momentum. It's probably the best time they could dream of to go public right now, with stocks at all-time highs and investors shrugging off every risk. And yeah, and I think you're right. The energy thing, that is eventually going to become a problem. It's been incredible to me how complacent the market is about the fact that we just continue to drain strategic reserves, not just in the U.S., but it looks like China. So there was really two main factors that prevented this market from just going ballistic to the upside. Energy, I'm talking about. In the wake of the Iran crisis, there was the coordinated release among the EIA countries with their SPRs. It was the largest coordinated SPR dump of all time, which is ongoing. But I think if you look at the US, we're basically we're getting close to like the bare working operational minimum of the SPR. So that game's run its course. In similar situations in overseas, we're basically exhausted the limits of Western reserves, coming up here at some point in the next, I'd call it 1 to 2 months at the maximum. But then China was also a big swing factor, because they have the world's largest strategic stockpiles. No one knows the exact number, but it's estimated somewhere around 1 billion barrels, which is like 3 times the size of the US reserve. And so they were able to basically choke off their imports by just domestically draining. They didn't flood it onto the international market like the Western countries did, but what they were able to do was draw down domestically and then not become a major source of import demand on the market. And between those two forces, that's really what helped balance about 10 million barrels per day of supply loss over the last 5 months since this conflict broke out. But now we're seeing reports that China is coming back into the import market because they must, at a certain point, they don't want to drain their stockpiles to zero. And especially if we're going to be foolish enough to basically drain, if the Western countries are going to be foolish enough to try to manipulate the prices, to $80 a barrel, I'm thinking China's going to start making the calculation that, well, there's a growing risk this conflict just persists. I mean, I don't know if you probably saw the headline. I think it was Tuesday or Wednesday of this week where Iran basically came out and said, we're pretty much done negotiating. Ignore the fake news from Trump. We're basically planning to just hold out until he's out of office and keep the strait kind of locked down until basically 2029. Now, who knows if that's bluster, negotiating tactic, or whatever, but the real bottom line is that, all the prognostications from a lot of the people saying don't worry over the last, ever since the start of this conflict was that, hey, this is going to be a quick thing. Trump will work out a deal. We'll get this strait opened up in no time. And here we are, going on month 6, and it's still, it looks like no real negotiating progress at all. And I think China is going to start to make the calculation that, hey, what if this thing actually does persist for the next 2 years? Maybe we should actually start rebuilding our stockpiles just in case, or at the very least, not drain them down to zero like the foolish Western countries are doing. So the way that all kind of comes together in the next few months is that we've still got a big deficit out of Hormuz, and if you can no longer paper over that with strategic stockpile releases and China cutting back on imports, you're going to have to balance whatever that daily supply loss is through the price mechanism of, pushing prices high enough to kill, who knows what the actual supply loss is, but call it anywhere from 5 to 10 million barrels a day, which would be on par with some of the largest supply shocks the market's ever contended with. And in that environment, I mean, there's no reason why crude couldn't go to 150, 200, or even higher. And yeah, you talk about Kevin Warsh's worst nightmare from an inflation perspective. I mean, that'll pretty much do it.
I agreed. I think part of what's playing into the China factor that we have to consider is that the Arctic route will be shutting down. Even though it's efficient for now for them to import Russian oil via the Arctic route, it is going to start shutting down as the ice cap begins to expand in the months ahead. So they're anticipating this and to restore their stockpiles. We really have no idea what they lost. And what a lot of people don't understand is there are literally hundreds of tankers parked by the Strait of Malacca, just sitting there, idle, waiting to be purchased. China will scoop that up, offload the oil at a bargain price, take care of their situation. We're going to be the ones left holding the bag because we aren't even we're not even at the point of capacity to produce a lot of the other goods, the helium, the naphtha, etc., that originate from the Gulf, from the Persian Gulf, and the loss of the Red Sea as a viable route for the large super tankers. It's starting to combine to be a very dark September, October, and Iran wisely, you can't fault the Persians. They're one of the most intelligent traders and negotiators in the world. They're playing the election, and they know if they can hold gas above $3.99 a gallon through the election period, Trump is going to get absolutely annihilated in the midterms, and that does have consequences economically.
Oh yeah, You've got to. They follow our politics probably as closely as they follow their own, and they know exactly what the situation is with the midterms. And yeah, I mean, I think you could see some fireworks. And again, it goes back to they're doing everything they can to lock down the strait. And every day we're seeing ships being fired upon for not following the rules there. And the market is willing to look past it because every week we drain another 5, 6, 7 million barrels from the strategic reserves. And it's enough to placate the market. But yeah, I don't think we're going to be able to make it to the midterms at this pace of drawdowns. I think at some point we're just going to exhaust that capacity. I mean, I didn't think we'd ever make it below 300 million barrels on the US SPR. There's different estimates out there about what the actual working capacity is and when you start causing structural damage to the reservoir and all that kind of stuff. But I think if you start getting into the low 250s or mid 200s, I mean, that's when I think almost all people would agree you really can't get much further below that. So that's maybe, call it 8 to 10 weeks of drawdowns at the current pace.
Wait until everyone finds out what happens next week, because you're from Texas, you're aware of this. By the way, boys and girls, it's time for seasonal change in the refinery runs. We're converting to winterlands starting next week, which means refining capacity takes a noticeable decline starting next week. If you're not familiar with that in the industry, go look at diesel prices, check the chart out, and prepare to be shocked. It will impact everything you see throughout the entire supply chain, especially heading into the late September, early October period. Ross, let's take a quick pause here. Please promote Porter and Company and your appearance on X. Let everybody know more about you.
Yeah, absolutely. So I write research for Porter & Co. We're a boutique research service, and we've got a whole range. We've got free publications. We've got paid publications. We do all kinds of different stock recommendations. I run a trading service. And the best way to find us is just to Google Porter & Co. Research. And if you want to check out any of our stuff, I can send you some free samples. You're welcome to DM me, and I can put you in touch with getting you something. We've had, I think, going back to your comment about being labeled in the perma bear category, we've been writing about these risks pretty much all year, ever since the Iran conflict broke out. But it's not like we're out here trying to short the market or do anything crazy like go to all cash. I mean, we're always looking for opportunities, and I think we put together a really solid year, just finding those opportunities in the market where it's a setup that it doesn't necessarily matter what the macro is doing. So we've had a really good time with the tobacco stocks, for example. And one of our biggest wins recently was, I view it as sort of the anti-AI trade, which is all these software stocks that just got tossed out and left dead on this idea of AI disruption. We had a big thesis that was well overblown, and that you can't vibe code, your way into a fully fledged enterprise, software with a full sales staff and support and all that kind of stuff. So we put together a basket of software stocks. I think they're up anywhere from 30 to 50% in the last few months. So, even though we're out here warning about the risks, we're always looking for those opportunities that, regardless of what our macro views are, there's always, values to be found in the market. So if you're interested, hit me up on the DMs, and I can put you in touch with some of our free research and let you take a test drive.
And on X, he's at Ross_Hendricks. At Ross_Hendricks. There's a link for Porter & Company there in his profile. Also, folks, MacroEdge.net/Ozone, MacroEdge.net/Ozone. Check out the free trial. Check out some of the things. You might get tired of reading my historical references, because one of my favorites is to talk about the 20s, not because I think there's a Great Depression coming, but if you look at the boom of the 20s, it was a tech boom. Radio, airplanes, automobile. We had hundreds of radio companies, hundreds of automobile companies, on and on and on. And what happened? We had a crash. The bubble went crazy. It went parabolic. Parallels can be found in history, be it the 20s, the 1870s, the 1970s, and now. Pay attention to what's happening and learn more from the MacroEdge team. Let's return to the AI trade, because you and I have been hitting that, but I think there's more to it than that. It seems to have become a politicized trade. And Ed Dowd, who's joined us tonight in the room, thank you, Ed, for hopping in to listen. We talked about the AI trade becoming something of a government-sponsored enterprise to some degree, where we're investing in rare earth software companies, microchip companies, etc. It doesn't seem like the typical trade when you start peeling the onion back and realizing we may have forced taxpayer backstopping on some of these mega hyperscalers without even realizing it. Does that not provide balance, or does that highlight risk, in your opinion, as we move forward in the market?
Oh, I think it's always a terrible mistake for the government to get involved in supporting any industry, really. I mean, it's never been a good idea. You just can look historically, and there's a reason why, the private market is for capital allocation, and the government is supposed to, at least it was designed to have a very limited role and almost no role in the economy aside from, making sure consumers aren't being poisoned by unscrupulous actors or whatever, basic protections. But when you start getting the government involved in actually making capital allocation decisions, it's just rife with conflict. And we see this, I think we're probably living through one of the most corrupt administrations of all time. And, the most blatant example was this Trump, 100K feed for getting inside information, which is, basically nothing more than, hey, we're going to tell you which stock Trump is going to tweet about, maybe an hour before the rest of the market gets wind of it, is kind of how I read that. And it's just rife with conflict. And I think the sad part about all this is AI has become such a kind of the last leg that this economy has to stand on, that when it all does, inevitably implode, there's going to be some kind of massive backstop, bailout, whatever you want to call it. And it's just going to be more taxpayer, socialized losses on the way down. And then of course, none of the executives that cashed out on their stock compensation plans are going to have to give any of that back on the way down. So it's privatized profits on the way up, socialized losses on the way down. I have, no doubt that some version of that is going to happen when this thing implodes. And along the way, I'm not sure what exact mechanisms are in place other than, right now they've got the government sort of involved in some of these data center projects, which again is a big mistake because, at the end of the day, we actually don't know if it's the wisest use of capital to be pouring into these extremely expensive data centers powering these money-losing AI models. I mean, what we're seeing in China is that they're figuring out how to do it much cheaper, much more efficiently. And every dollar of capital that is incentivized to possibly go into this less efficient route is just going to be money that's ultimately, it's capital that's going to be destroyed. And anything that the government does to keep capital flowing into what might end up in hindsight looking like a big waste of capital is just going to make society poorer in the long run. And so, yeah, I think it's all just anything that the government touches in terms of allocating private capital is almost always a mistake, in my opinion.
With that, we're looking at a prospect where the Defense Production Act is going to be expanded to include industries that traditionally were not part of the formula nor intent. When you start reviewing the private equity and private capital investments, what we used to call venture capital back in the old days, and say, okay, we're going to give you this money, and here's where we expect it to go, and here's what we want you to do with it, provide the returns, et cetera, et cetera. I'm simplifying this for the purpose of expediting the discussion. But when you start reviewing what the consequences are when we start putting backstops behind that, doesn't that increase the misallocation of capital towards enterprises that are unproven or even more potentially providing opportunities for investors to be deceived by the returns that are being promised?
Yeah, exactly. I mean, when you have a backstop, what that's really telling, and it's especially when it's government provided, what it's really saying is that, hey, the private market, all else equal, is for whatever reason unwilling to risk their capital into this project. And so if it requires a government backstop, it's almost by definition, not an economically attractive place to allocate capital. So yeah, I think it's a big mistake for whether it's a backstop or a subsidy or anything that the government does to get in there and put their thumbs on the scale of what the economics of an investment. It's almost by definition less efficient than if the private market were to just handle it. Because if there was a true ROI opportunity there would be private capital willing to go into it without that backstop.
That was one of my favorite posts of yours, by the way, where you tried to sit there and explain once again the difference between revenue and ROI for the idiot out there who didn't seem to understand that concept. highlight your worst case scenario that we've witnessed lately, because there are a lot of people who are misinterpreting revenue as profit. And I've tried till I'm blue in the face to explain it to people. And I've also tried to explain, just because they issue a 3x, 4x, 10x levered ETF against an individual issue, it doesn't mean that it's a profitable company.
Yeah, well, I think the clearest example of that this week was the CoreWeave, or I think all of the neoclouds are in the same camp, but I focus on CoreWeave in particular because it's kind of a full disclosure. I have a personal bet against that company, but yeah, you see them put up these big revenue growth beats, and everyone's all excited about, hey, look how fast they're growing, and then the big upside surprise was, oh, they've got a backlog that grew. I think it's $100 billion plus backlog, and everyone's excited about that. But the funny thing about these neoclouds is that the more revenue they generate, the more cash they burn, and the more debt they pile on. And it's amazing that they report these adjusted EBITDA numbers as like the headline profitability, and it's like these are some of the most capital-intensive, debt-laden companies on the planet, and you're stripping out interest, depreciation costs, and it's like you don't do that for a capital intensive business. Like, those are real cost of doing business, and you see it in the cash flow statement where they actually burned $6 billion in a single quarter, which is incredible to me. And the stock was up 20% on that because, hey, the revenue is growing and the story's working. It's all going to be great in the future. And I think the neoclouds are, to me, the equivalent of a lot of the telecom startups that were basically got swept up in the mania, the late stages of '99, and that was the epicenter. A lot of people like to focus on like the pets.coms, like those were obvious, hype stories, but the real carnage was in the telecom sector, where I think like 18 out of the top 20 telecom providers that were laying down the fiber, because it was such a capital intensive business, they went bust and they took massive losses, not just on the equity, but the bondholders. I mean, I think you're looking at, in a normal bankruptcy, you might recover 60, 70 cents on the dollar, but there was carnage among even the bondholders, which were supposed to be the more protected higher up in the capital stack. And you were looking at 20, 30 cent recoveries on the dollar. And it's the same business model. The data centers are very capital intensive. I would actually argue it's worse, because when you lay the fiber down, if you don't use it for 5 or 6 years, it's still a viable asset. We're using fiber today that was laid down in the .com era. But if you fast forward 25 years from now, we can almost guarantee that none of the NVIDIA chips that the neoclouds are buying are going to be in any way useful. And so it's the worst business model you could imagine, where you're borrowing tons of money, paying massive interest costs to buy rapidly depreciating assets, and you're basing it all on the spot prices today that these GPUs can garner. And for all we know, 2 years from now, there could be a massive glut of compute, and the prices you paid, you might not be able to make any money with those GPUs 2 or 3 years from now. And so I think we're going to see, if you want to look at the epicenter of where you're going to see the biggest wipeouts in terms of stock and bondholders, it's going to be in the neoclouds in this sector. That's kind of my prediction. For it'll be a fun one to track, though. But that's what I'm thinking. Is you can look at the CoreWeaves, the Nebiuses, the Irons. I'd be surprised if any of these companies are viable 5 years from now.
Which brings me to the credit side of this equation. It's amazing that people are ignoring the insurance levels, CDS, on some of these companies and how they're getting blown out right now, including NVIDIA, boys and girls. What is your take on the credit risk, especially private credit that we don't see, but the credit we do see, the publicly traded bonds, that apparently a lot of people suddenly don't have faith in? And boys and girls, we call the bond market the smart money for a reason. Take it away, Ross.
Yeah, it's amazing that NVIDIA, which is a company that prints $50 billion in free cash flow every quarter, is all of a sudden seeing the bondholders get worried. Now, I'll caveat that by saying the absolute level of the CDS isn't implying any kind of distress, but I think what the bond market is worried about is, and you don't see any of this on the balance sheet, but it's all these backstops that we're talking about. Where NVIDIA is basically, I mean, they've been doing this for the last 3 or 4 years. It kind of started with the CoreWeaves, some of these neoclouds, where NVIDIA is doing this weird kind of backstop where they'll sell the GPUs to CoreWeave and they'll agree to rent them back at a certain price if CoreWeave can't find a buyer in the market, basically. And that's giving CoreWeave a license to go out there and raise all this debt, saying, hey, look, I've got this backstop by NVIDIA, right? And that's what allows them to go on this crazy debt-fueled GPU buying spree. And I haven't looked through, but it's in the footnotes of NVIDIA. Someone actually has done the work on this and went through and tabulated it all up, and it's some crazy number. I don't know it off the top of my head, but I want to say it's well over $100 billion in terms of the backstop commitments that NVIDIA has agreed to through these various vendor finance deals with these neoclouds and other parts of the ecosystem. And the crazy part about it is, right, it's a situation that if you just look at the spot prices of what GPUs rent for in the market today, it's like, okay, I can understand how that makes sense. Maybe NVIDIA is onto something here where the economics, they look pretty good right now. You buy a GPU, you can rent it out and make whatever X% return on it. The problem is, and so if any one company fails, like, okay, great, NVIDIA will take the GPU back and they can give it to somebody else and they probably won't lose money on the deal. The problem is you look forward a couple of years and the worst case scenario for a company like NVIDIA that's involved in these sort of backstops is you get to a situation where the entire market is saturated and it's not just one or two handful of companies that for whatever reason can't make the economics work, but it's every GPU buyer in the ecosystem is suddenly sitting on these assets that are not able to generate a market return because there's a glut of compute. And you can imagine any number of scenarios that would cause this, whether AI demand falls off for some reason, or there's this influx of cheaper models that the Chinese are suddenly figuring out, or there's some kind of technological breakthrough where maybe you don't need 1,000 GPUs in a data center, maybe you only need 100, or maybe you don't need GPUs at all. But there's any number of scenarios where you find yourself 2-3 years in the future and every single one of these backstop agreements comes due at the same time, and NVIDIA has no ability to either resell or re-rent that out and recapture any kind of value, and they're stuck holding the bag on these massive off-balance sheet commitments. And I think that's what the bond market is starting to get concerned about, and I think it's a very real risk. And you can imagine what that would look like for the entire AI ecosystem if one of those scenarios unfolds, whether it's cheap Chinese models or a shift to a new architecture. I mean, just think about all the capital that the hyperscalers are sinking in. It's going to be $1 trillion a year soon. And they're involved in a lot of these same kind of circular deals with backstops to neocloud providers as well. So it's a situation where you can see that there's a ticking time bomb that's been set off, and there's any number of factors that could, press the countdown clock button to get this thing going. But yeah, it's a big risk that's out there, and I think the bond market's starting to price that in.
I'm going to refer Ross and our listeners to some guests we've had on here numerous times, and one of the members of the MacroEdge team, at JG Nuke on X, at Just Dario on X, at Kalkashi on X, who has his own private subscription service now, and of course our own Ed Dowd, who has been out here. Ed's been fantastic describing what's been happening in this area. If you haven't listened to the shows on this subject, I would recommend you do so. It is important because we've reached a new level of absurdity with what we're going to talk about next. And it circles back to the speculative nature of the markets and their top. I mean, I'm almost willing to say that October 5th will be the equivalent of September 3rd, 1929, marking a market top. I'm not going to put that in stone right now, but on October 5th, pending regulatory approval, and this, Ross, I got to get your opinion on this because the subject matter is germane to what we're talking about. You can now trade on the CME compute futures for the H100 GPU rental and the B200 CPU rental. I've never seen that in my entire life. It's not a physical commodity that I can take delivery of. It's a rental. What do you make of the speculative fervor when we're trading rental capacity on GPUs?
Yeah, I mean that's what you see as these manias unfold, is the increasing financialization of the hot item of the day. So I'm waiting for the collateralized chip obligation. That's what I'm kind of waiting for. But yeah, getting these tradable compute contracts, I do think there is one positive to that, which I think, again, there's so much of this ecosystem relies upon, what are these chips worth and what are they renting out at and what's the ROI for all this CapEx spend going on. We don't have a ton of clarity on exactly what that looks like, but I do think that the positive of having these contracts out there is it will give the market a better sense of tracking, are these rental rates increasing? Are they holding steady over time? Or it'll be a nice leading indicator if we do get to one of those scenarios that I painted earlier, where for any number of reasons, maybe GPU demand starts falling off and the rental rates start going down with it. I think it's actually going to be a good thing to be able to track that through a liquid market. It'll be kind of a real-time indicator of what the economics of all this data spend is. And so, I'm sure a lot of shenanigans and people are probably going to lose money trading this stuff, but I'm hoping that there's no ETFs that go get tracked on the back of this, because that's how the retail traders will get burned. But if it's a futures market, hopefully it's mostly professionals trading this stuff and they're basing it, on some semblance of reality that's happening in the real world. And if that's the case, which I tend to think that's how it's going to track, is what are the actual economics of these chips. I think it's actually going to be a really good thing for us to be able to monitor how are the economics of these chips holding up over time. And I think I'm actually kind of looking forward to using that as sort of an indicator on this whole AI boom and whether this CapEx cycle is potentially reaching some kind of turning point.
I think we have reached a turning point because the H100 came out in 2022. So, in my opinion, we're basically trading futures on the Ford Aerostar. And that's disturbing that we're going to sit there and take a used car, which is coming to the end of its functional usefulness in 2027, 2028, as the performance deteriorates compared to the second evolution, a new generation that's coming out. As the architecture is advancing, no one has repealed Moore's Law as far as I'm known. Even Trump can't use an executive order to get rid of that. So we're at a point now where we're going to sit there and take 4 to 5 year old technology and trade on that. But even the Chinese don't want it, for God's sake.
Yeah, no, I think it's going to be really interesting, and it's another big thing is that, so going back to one of the big talking points, been following the CoreWeave story closely, so just going back to that, one of the big sort of bullish data points that came out of this release, according to the bulls, is that they were able to keep. They basically were able to use like an A100 and the extend out the life to that, supposedly for it had like a 10-year lifespan where they're still making money. And that was one of the old generations, I think even before the H100. But of course, that was a very misleading data point, because they just mentioned one certain group of A100s that got some X amount of rental rate. But it's classic case of statistical, fooling people with who don't understand statistics. The real metric that they should, if they wanted to tell that story, was we bought X number of A100s, and of that initial batch, here's how many are still in operation, or we're able to get a contract going out to X date. But they didn't do that. They just took one isolated example. And of course, on a batch of 1,000 chips, you're going to have different rates of drop off depending on things like usage intensity. And the real metric is on the whole universe, the whole vintage class of those chips that were purchased, how many are still in useful operation today. But the plus side, going back to what I'm actually excited about this contract, is it will give us that kind of insight into, now we're going to have a liquid market for a very certain class of chips, the H100s. And I agree, it's silly that people want to speculate on this stuff, but at the same time, if it's a real-time price, and it should ideally track pretty well with what's happening in the real world if the markets are efficient. That will give us a sense to basically refute a lot of the bullshit narratives that are out there about, oh, we've got A100s that are still in use 10 years later, or whatever nonsense the AI promoters are telling us. We can actually look at what these chips are doing in the liquid futures market, the implied economics on them. And I think I'm actually all for transparency, because I think that's the one thing that this whole AI bubble lacks, is transparency. There's so much that's going on beneath the surface that you don't have access to if you're not on the inside. And getting access to the chip rental rates, I actually think is going to be a really key part of this story. So as kind of degenerate as that idea sounds on the surface, I think that there could be a positive spin on it potentially.
Okay, I'm a degenerate, so I can respect that remark. Let's go to speaking of degeneracy. Let's go to commodities real quick. There's a lot of feedback loop negative speculation from the El Nino hitting the ags finally. Ags are coming to life. At the same time, it looks like gold may have hit its cycle bottom. I think it may still have one more retest in the future. Silver, same thing. If this indeed does mark a cycle bottom for the commodity complex minus energy, should that not be concerning for the deflationistas, or should it be more concerning that it will force a more severe deflationary turn as demand destruction intensifies heading into the end of this year?
Yeah, well, one of the things about the ag market was that was supposed to be one of the big bullish outcomes of the Iran conflict, because the fertilizer supply chain got all tangled up, and that was an actual bigger supply hit than anything with crude oil or even natural gas. I think something like 50% of the world's fertilizer, whether you're looking at urea or different kinds of phosphate fertilizers, come out of the Persian Gulf. And I think one of the reasons why the impact was blunted was because I was following the wheat, for example. That's one of the markets that I spent a little bit of time on earlier this year. And so there was a big hit to planted acres globally, but the offsetting factor to that was we had a bumper crop last year. And so we entered this season with some of the highest wheat inventories on record. And that basically helps kind of blunt the impact of what's going to be probably a pretty weak planting season this year. But as you roll through this, and if we assume that these disruptions remain in place with the Strait of Hormuz, I think we're setting the stage, and I think maybe that's what the market might be starting to price in here with this grain rally, is looking forward to the next crop season, when you've worked through a lot of the excess inventories, and you get around to another year of really high fertilizer prices, which means a lot less application and lower crop yields for the next following crop season. That's when the rubber could start to hit the road in terms of you actually start to feel that supply hit from. It's a very long lead time as you go from high fertilizer prices to the end crop season. And if you have high inventories in the meantime, you can kind of blunt the impact. But on a long enough time scale, that will start to matter. And I think that is going to become a big risk, because it's easy to potentially ration energy demand. You can take that one less discretionary flight, or you could drive fewer miles if you really want to cut back. But it's hard to cut back on food consumption, especially in America here, unless you're on the Ozempic, I guess. But I think that could be the next big commodities rally if this situation with Iran persists and you continue to get this fertilizer supply disruption that goes into the next crop season.
I agree with you, and I also think that the fact that the Russia-Ukraine war has expanded to the point of sinking every grain ship and attacking grain terminals now is going to have a major impact on prices heading into the spring of next year. Let's hit one more question, and I want to let you go after that, because I know you value your time, and so do we as your host, and we appreciate you coming back on again. The credit market flashed a warning sign on the long end today with a 30-year bond auction with the highest yield since 2001. Is this a message to Warsh to get his house in order and quit talking about controlling inflation? Or is this simply international investors saying, okay, we've had enough of the garbage and promises? Because we had the message today that came out that there will be no maintenance, so to speak, of the reserve management from now through September of the Fed buying T-bills, which is a disturbing sign, because if they're not buying the short end and they're not buying the long end, just letting it roll over, there's a lot of liquidity risk approaching the market in the next 60 days.
Absolutely. I 100% agree. And I think there's actually, I think Warsh is boxed into a pretty tight corner here. He's got a number of things coming at him. So there's the whole energy, food inflation angle that we just mentioned, which is really out of his control. You've got, as you mentioned, there's overseas pressure, and Japan is having a real hard time controlling the devaluation of their yen. And I don't think they're going to get that under control anytime soon. Their rates need to go higher is the bottom line. They're still at about, I think, a 200 basis point discount to US. And what that's causing is a big capital rotation out of Japan into the US. And that's where you're seeing that pressure on the currency, and you're seeing the very poorly performing interventions that Bessent is trying to organize that are, the market's kind of laughing in his face every time they try to perform some overnight operation, whether it's selling euros to buy yen. I mean, it'll cause a 2 or 3 day, drop, and then prices go right back up. So you've got that pressure in Japan. The way that they can basically shore up their bond market is in their fiscal situations by selling treasuries. And I think that's going to be, that overhang is going to be out there for, I think, years to come. So that's a big factor. And then the third one that I would add on top of this whole thing is that I think there's a crowding out effect going on with all of this debt that's being raised to fuel the AI boom. You're seeing the banks are starting to balk at some of these massive debt raises, whether it's you're seeing the hyperscalers raise, you're seeing the neoclouds raise, and everyone in the whole supply chain complex. We're on pace for a record corporate debt issuance this year, and that ultimately that money has to come from somewhere. And I think that's another factor that's pushing up treasury yields. So you kind of put it all together, and it's hard to see how they're going to get rates down without some kind of massive intervention in the market. But as you mentioned, they're rolling off the reserve management system, and it's one thing. We were able to do QE in the 2010 era because there was no inflation risk, and the market was able to look past the Fed blowing up its balance sheet to buy bonds because, at least the headline inflation was Yellen was struggling. Her goal for many years was to get inflation higher, and they couldn't do it because the economy was stuck in slow gear, and the overhang from the GFC. This is the opposite situation where we've been dealing with 5 years of above target inflation, and so it's not obvious to me that even if the Fed wanted to restart QE and start expanding the balance sheet to buy bonds, that maybe the long end would treat that as a loss of confidence, and you might be able to force short end rates higher, but maybe the long end revolts because they see the inflation rearing its head down the line, and they start charging a higher premium for that. So I think Warsh is boxed in. I would not want his job. I see only negatives for the bond market, and it's hard to see how they're going to get this under control. I guess the one saving grace in terms of the bond market, at least, would be a recession. And maybe that's how this thing gets under control eventually. And, maybe higher rates could actually be one of the catalyzing factors that leads us into recession. But I think Warsh is going to have a tough first couple months on the job here, it looks like.
Yeah, he's beginning to feel a lot like Alan Greenspan in September of '87.
Yeah, right.
Folks, I mean, look, I'm a history guy, so Ross knows me. He follows me on X. I follow him on X. And if you're not following Ross, at Ross_Hendricks on X, Ross, promote Porter one more time.
Yeah, so the best place to find our work, our research, again, is Porter & Co. Research. You can Google us. If you click on my profile, I've got a link that goes straight to our website. And again, we've got all kinds of great free research. We've got great paid services with stock selection and trading services. So yeah, feel free to check out our website or get in touch with me in the DMs, and we can send you some free samples and get you on board with the kind of stuff we're putting out there these days.
And I will post a picture of his profile in the MacroEdge thread for this because, folks, we love our guests. They bring a perspective. We look to provide perspectives, not just my boring old voice and my, oh my God, we're all going to die perspective. We're not all going to die, but we're going to have some rough times ahead as we get through this. The bond market is sending a message. Ross highlighted that. The commodity market is sending a message. And history always sends messages. Pay attention at macroedge.net/ozone. Get your 2-week free trial. We should have a show tomorrow night. We're waiting for final confirmation of our guest. If we have a show tomorrow night, it is going to be, and Ross, you'll love it, it's going to be the energy guy. And
nice.
And it will be one of the, because everyone focuses on gasoline prices at the pump. It's a lot more than that. And we do have some of our other guests returning next month and the weeks ahead. We are going to sit there and hit this hard because I think heading into September and October is going to be some of the more turbulent times that we've seen in the last 40 plus years. For MacroEdge.net and MacroEdge Radio, this is John Galt. Good night now.